Hi, David. This is Soram Jung, correspondent for Korea Economic Daily. And thank you for your available time in this volatile market. A lot of things happen in these days, especially the CPI was announced today, and the market is mixed. Although the inflation has slowed, investors are pondering future investment strategies considering the inflation and a lot of the index. So how do you analyze today's CPI index, and is there any special point that we really need to pay attention to?
Yeah, thanks for having me, Saram. The CPI data today was pretty much in line with expectations. What we've seen over the last several months is that inflation had been running very hot, and now it's continuing to moderate. So the precise numbers were the headline inflation was down to 5% change year on year. That's a lot better than where it was at over 9% several months ago. So clearly moving in the right direction. The core inflation didn't show as much of an improvement. It's around 5.5%, actually 5.6. But also generally moving in the right direction. And what we did see in the report today was that some of the things that have been holding the inflation numbers higher have been more housing related. And at least for this month, we did see the housing related inflation components improved somewhat more than people expected. And we think we'll continue to see that going forward. The housing related data comes in with a lag. So they're around 5%-ish, 5% on the headline, 5.5% round numbers on core. That likely will continue to come down, especially because we know that the current housing market data is quite a bit softer than what's reflected in the CPI. And as that lag goes away, then we'll see these numbers continuing to move in the right direction. So I would say overall, pretty much in line with expectations, and continuing to show some softening in inflation. But I guess the one final point I would just make, Soram, is that underlying inflation is probably still too high for the Fed. That it's definitely not at the Fed's target, which we know is 2%. And we probably need to see more work to do to get inflation down to the Fed's target.
Yeah, thank you. So we need to focus on the housing market data, just the following data. So the market is now focusing on the FOMC meeting in May, which is next month. So we think that there are a higher probability of the 25 basis point rate hike based on the indicators after the CPI index. How do you analyze the Fed's decision and its future rate hike cycle?
Yeah, so Saram, we think that the Fed will increase rates by 0.25 percentage point at the next meeting, as you mentioned, in May. And that's pretty much in line with market expectations. The market has more likely than not odds that the Fed will increase rates another time in May. I think what makes it a little more challenging, though, from after May is, as we know, we've seen a lot of stress in the banking system here in the United States. And I think what the Fed is trying to understand is how much of that banking stress is going to lead to, is going to be the same thing as a rate hike. How much is that going to lead to a pullback in lending on the part of the banks? So this is a key variable. If we don't see much stress coming from or if we don't see much impact from this banking stress, it's possible the Fed will have to raise rates even further. If the impact of the banking stress does show up, then this could be the last rate hike. Now, it's probably the case that the Fed is going to need to keep rates wherever they end up, at these high levels for quite a long period of time, very likely until something breaks in the economy, whether we end up in a recession or not. Or until inflation really comes down closer to the target that we were talking about. That's going to take some time. So right now, market expectations have the Fed cutting interest rates later this year, that seems unlikely to us unless it's very clear that we're in a recession at that point.
Thank you. And since you mentioned the banking problem, let's talk about the banking crisis. So the banking crisis has subsided somewhat, but some experts say there will be more crises, especially in the regional banks, also in commercial real estate side. So how do you diagnose the current banking system, or are there any remaining risks in the banking side which we need to watch out for?
Yeah, so in our view, Saram, we think we're past the worst of the banking stresses. The Fed has put in place some emergency programs that make it basically backstop the system, provide more liquidity to the banking system. Also the FDIC has basically put together an implicit insurance of all deposits in the system. And I think that's gone a long way to quelling the crisis. If you look at some of the data that comes out from the Fed on a weekly basis, the usage of some of these facilities has stopped going up. In fact, it's started to go down a little bit in the last week or two. So, it looks like the worst of the crisis is probably over. Now, look, that doesn't mean that every single regional bank is that, well, in other words, there could be more bank failures. That's certainly possible. There are a number of banks that are still under a good amount of stress, and it's not clear exactly how they kind of get out of this. But I also think the contagion, if those banks were to fail, would be nothing like we saw earlier back in March because of these Fed facilities that are in place. Now, to pivot to the commercial real estate, that's also been another issue that a lot of observers and investors have started to bring up. We don't think the commercial real estate issues are really a big deal. I think there's not enough analysis being done, quite frankly. I think when you look at commercial real estate, when people talk about commercial real estate, oftentimes people think of office properties. But the reality is that office buildings are only about 20% of commercial real estate. And yes, there's going to be, we already have seen some defaults in select office properties. It's certainly possible, if not likely, that we will see some others. But bear in mind that it's a small segment of commercial real estate. The loan to values in general are not very high for many of these properties. And also this is going to take a long time, right? I mean, leases that the folks who are leasing in these office properties tend to have long-term leases, usually around 10 years. And so it's just going to take a long time for this to play out. So it's not a place where you necessarily want to be in the office segment of the commercial real estate market. And it's going to be challenging, but is this a systemic risk or something that's going to really impair the banks? I really don't think so at this time, just given that it's really just not a large part of the overall size of commercial real estate.
Yeah, so it's not a short-term risk. So thank you for your view. And then let's then move to the strategies. So I remember that your team recently stated that you guys do not see the possibility of a new bull market. How do you predict the future path and the bottom of the S&P and the Nasdaq index? And how do you forecast the entire market after May, including stocks and bonds and the dollars? That was the question.
Sure. So I mean, super big picture. I think the S&P 500, the U.S. equity market, it's basically been in a very wide range over really since last summer. All right. So it's been, if you look at the S&P 500, we've been sort of at the low end in the high 3,000s. At the high end, it's been in the low 4,000s, and we're now creeping up towards the higher end of that range. And I think the market's going to remain in this range until we really find out if the U.S. economy is going to have a soft landing. In other words, if there's no recession, or if we do have a harder landing where there is a recession, where the unemployment rate moves up. That's how I would define a recession. I think it's going to take some more months before we know the answer to that question. Now, in the different scenarios, in the upside scenario, soft landing scenario, maybe there's 10% upside because valuations already have moved up. We're trading at a pretty rich multiples for the U.S. equity market. But if we slip into the recession scenario, there's probably 15 to 20% downside. We're a little bit cautious. I mean, I do think that for inflation to get fully under control, we probably do need to see some modest move higher in the unemployment rate. That'll probably lead to some pullback in consumer spending. So our year-end forecast on the S&P 500 is 3,800. The market's a little bit higher than that right now. So we are a little bit cautious on the market, just given the likely negative effects of the lagged effects of the Fed rate hikes. Why we also don't think this is necessarily the beginning of a bull market is the starting point is just not great. I mean, valuations are the PE multiple in the S&P 500, 18 times earnings. The long-term average is about 15 and a half. So it's above average, and earnings themselves are above trend. Earnings, if you look at a trend line over many decades, they're about 10% higher than normal. So, that's just not the right recipe to have a prolonged multi-year bull market. Usually you'd see that happen if you had below trend earnings and below normal valuations. Now, in terms of fixed income, we actually have a least preferred view on equities. We actually prefer bonds at this point. And we just think you can get better returns and certainly better risk-adjusted returns in the bond market, especially now that interest rates are higher. And we have a target on the 10-year Treasury of 3.25 by the end of this year. That's a little bit lower than where we are today. So you get the coupon, plus you get a little bit of potential price appreciation as well. On the dollar, we have what we call the least preferred view on the dollar. We actually think that the dollar will weaken. That's because the Fed is largely done with its rate hiking campaign. Maybe, like we said, probably one more interest rate hike, possible a couple more after that, but not necessarily, that the next one could be the last one. Other central banks are still raising, and the dollar is expensive. If you look at the dollar based upon purchasing power parity or other ways of looking at it, the dollar does look pretty expensive. So the end of the Fed rate hikes, expensive dollar, we think the dollar is going to weaken from here.
Yeah, thank you. And you just mentioned the earnings of the companies, and actually the first quarter earnings season just began this week. Especially the banks will release the earning tomorrow. So how do you think this earnings season will turn out? And are there any sectors that you're paying special attention to?
Yeah, so I'll answer the second part first. I think everyone's going to be looking at the banks. So that's going to get a tremendous amount of attention, not just the large banks, the regional banks, but obviously, given all that's happened over the last several weeks, that's going to get a lot of attention. What's happening with deposits, what's happening with loan growth, what's happening with the cost of deposits, all that kind of stuff. But I think more broadly, I actually think this earnings season is going to be pretty resilient. I think the bar going into earnings season is fairly low. If you look at the estimates out there, the estimate for the first quarter has come down by over 6% over the last 3 months. Yet at the same time, we've seen economists have upgraded their GDP growth forecast for the US economy from 0% a couple months ago to now around 1.5% for the first quarter. So I think the numbers are going to be certainly better than feared. The job market is still adding jobs. Consumers have excess savings. The dollar's weaker. That helps corporate profits. Supply chains are getting better. So I actually think you're probably going to see somewhat more resilience in earnings. Now, I don't want to overstate it. We're still going to be likely looking at year-over-year declines in earnings. We think around 1 to 3% decline versus the year ago period. But we also think that companies are going to be beating expectations by a decent amount, by about 3 to 5%. And I think the outlook that companies are going to give is not going to be too negative. Again, if you look at what the economic data I just talked about, plus the fact that consumers are still spending because they've got jobs, they have the excess savings. So I don't think we're going to be looking at a material weakening in the economic or in the outlook for corporate profits, at least for the second quarter. I think there are more questions later on in the year. We think the estimates that are out there for the second half of the year do look pretty aggressive. They're looking for a pretty substantial improvement and pickup in earnings growth. We're a little bit skeptical of that. But I think in terms of the first quarter results and the near-term guidance, I think it's probably going to be much more resilient than some of the fears out there.
Thank you. So, like you said, a lot of the Wall Street experts sees the cautious view in the second half. So the people are just confused to what they should do. So some people just want to look on the China or the other market instead of the U.S. market. So I just want to ask you that: are there any assets or the countries beside United States market that you are especially just positive about?
Yeah, actually, our preferences within the equity market are actually, we prefer areas outside the United States. So we have a most preferred view, and we're overweight in emerging markets. Obviously, China is a big part of that. But at a very high level, the way I think about it is that you've got earnings in emerging markets which are probably 20% below normal, and you've got valuations which are in line with normal averages. You know, that's very different from what we were just talking about with the United States, where valuations are higher than average and earnings are higher than normal. So emerging markets look pretty interesting, obviously powered by China to a very large extent, where the reopening of the economy, you know, that looks like it has a lot of momentum behind it. It's not going to be a straight line, but we should see some much better performance coming out of China. Plus, you've got policy easing across a whole host of dimensions in China, whether it be monetary policy, property policy, technology policy, social policy. There's a lot of easing of policy initiatives going on in emerging markets, well, really in China specifically. And we think that's going to power some pretty decent earnings growth in the quarters ahead. Plus, valuations are really not demanding. Plus, if we get a weaker dollar, that would only help the emerging market story. We also like Australia. Australia happens to be, very commodity-related marketplace when you're talking about the equity market, and we think there's some interesting stories there within the commodity patch, and Australia is a way to play it. So the main message here is that look beyond the United States for some of the best opportunities on a tactical basis. Again, focusing on emerging markets and Australia.
Oh, thank you. So your message is look beyond the United States. So it was the end of the question, and thank you for your view, and thank you for your time in this volatile market, and our viewers will really love your interview. Thank you so much. Bye,
Thank you, Sarah.
David. Yeah, okay.